Good morning, everybody. Welcome to this EABH conversation with Christoph Trebesch. We're going to talk about disasters today, about official lending and how to cope with disasters. My name is Carmen Hoffman. I'm Secretary General of EABH, the hosting institution of this conversation series. So EABH, that is an independent international membership-based network, and we promote research into financial history, policymaking, and the archives. And of course, as such network, we rely on a membership base that values independent research in financial history. So we are a small organization, we are independent, and you all know it's a competitive world out there. There are bigger, often state-funded other players. So if you do like this talk and if you like our work in general, you're very welcome to come and join EABH. It's very easy. Just go to our website, bankinghistory.org, and choose the membership section. There you find different options for corporate members, universities, individuals. Good. This being said, now let's start to talk about official lending and why it matters in times of distress. And we're going to talk with Christoph Trebesch, who is the Director of International Finance and Macroeconomics at the Kiel Institute for International Finance. Before I hand over to Christoph, one last thing. We're going to record this presentation and it will be available online in the next few days. If you have any questions, you can put them in the Q&A or chat function. We are going to address them after he finishes. If you would like to raise your hand, we can even hand over the word to you over video at the end of the talk. Okay, Christoph, the floor is all yours.
Thank you so much for the kind invitation, for allowing us to present our work. Let me jump straight to the slides and share my screen here in the hope that that works. Now what's okay, here you go. Too many open. There you go. Okay. So yes, this is joint work. Can you see this, Carmen? Yeah. Okay. So this is joint work with Sebastian Horn of the Kiel Institute and Carmen Reinhardt of Harvard University, who's currently at the World Bank. The reason we started to work on this multi-year project, the motivation to delve into official lending was that we are observing that this type of state-driven lending is on the increase again. So what do we mean? Let me start with that. By international official lending, we mean lending between governments of two independent states, lending between two central banks of independent nations, or lending between a multilateral organization such as the World Bank or the IMF to a sovereign debtor government, right? So intrastate lending, that is the focus of this paper, of this research agenda. And we are observing that with the rise of China and south-to-south flows, with the rise, with the events of the great financial crisis and the Eurozone crisis, we've seen a strong increase in these state-to-state lending activities. And we've seen also an increase in the role of central banks, who are also official actors, official creditors, and all these institutions are becoming more important for global financial markets. So we wanted to delve into this phenomenon. We wrote one spin-off paper on China, looking into China's official international lending, but this is the bigger picture on this topic. If you want, given that this is a history seminar, many of you will know that in the 50s and 60s, official lending, international official lending, so government driven by states, was the so lending given by states was the only game in town. So in a way, we are seeing that this pendulum is swinging back. New actors like China are more active in granting credits via governmental institutions. And this paper is tries to paint the picture of this type of lending, of this market of government-to-government lending in the very long run. We focus in particular on lending during disasters, such as natural disasters like the current one we are living through, but also wars and financial crisis. So we look at disasters in a very broad sense, and we're interested in how the international system responds to these disasters, and in particular via international official lending, right? So that's the focus of today. When we started the project, obviously we didn't expect the next global disaster to occur so quickly, but never, so let me therefore motivate the talk with a slide on the COVID disaster, right? And specifically on the first few months of this event. So this graph shows you the collapse in private capital flows. This is commercial, so net debt and equity purchases of non-residents to 32 emerging markets. So this can be understood as a proxy for portfolio outflows from emerging markets in the wake of the COVID disaster, in the wake after the outbreak of the virus on a global level. And what you can see is that the outflows from private outflows from emerging markets was very large, approaching 200 billion in a matter of just 2 months, making this one of the major sudden stop events, events of sudden reversals in capital flow in history. And these type of sudden stop events are well studied. It is well known that private capital flows are pro-cyclical. They enter when times are good and they exit quickly when crises turn up, when times turn sour. And there's a lot of literature both theoretically and empirically examining these booms and busts in private capital flows. What was much less known is the other side of the coin, the official capital flows. And as we have seen in this crisis, along with a sudden stop in private flows, we've seen a sudden spike in official flows. So what you can see here is we collected data from the IMF, regional development banks, and the World Bank on lending commitments to the same set of countries. And what we can see is that lending commitments have increased strongly and have continued to do so in the wake of this crisis. So in response to the shock, to the massive outflows of private debt, we have seen, of private capital flows, we have seen a drastic increase in official capital flows. Some of these commitments have not materialized, that were never dispersed. Others have, but commitments have continued to rise. So it is quite certain that we have seen a very counter-cyclical movement here. And we will see later in the talk that this is a very typical phenomenon in crisis situations, that official capital flows tend to increase during disasters, whereas private capital flows tend to decrease. What motivated us to delve into this project was really the fact that to get this, it's so much easier to get information on private capital flows. You know, to compile this line, this is IIF data. It took us basically two hours. Whereas the blue and gray shaded areas, there is no central data set recording official capital flows in a systematic way. We lack bilateral flows here. We still lack central bank flows, so swap lines and all these other mechanisms. So in other words, we're only painting a partial picture, and we're doing so because it takes so long to gather all this data. So only to gather this data took us a couple of weeks. We have not updated it for the same reason. So there is simply no unified data set, no unified data resource on official capital flows, especially not on a granular level, on detailed lending level, transaction level. And that's what motivated this paper. We know very little about the universe of official international capital flows. There's this huge literature on private cross-border flows. There's a very rich body of work. There's also a number of papers on international official flows. Laura Alfaro, co-authors, have contributed to it. There's quite a number of people working on individual sub-episodes, but what is missing is a broad-based picture on this phenomenon, not just focusing on one type of creditors, such as IMF lending, right? There's a lot to show on that part of it, but there's kind of like what we missed is an encompassing understanding of this phenomenon, both in history and today. And this is what this paper tries to contribute to a certain degree. So we provide the first broad-based database and analysis of official international lending from over the past 200 years. We define official lending, as I said, following basically the OECD and IMF definition, so including loans, grants, and guarantees by governments and state entities, so multilateral institutions and central banks. We draw on a broad range of sources, which are all detailed in the paper that you can download online. So we draw on international treaty series, so we benefit from the fact that historically, when we look at the 18th century or 19th century, all these loans, all these transactions were written down in treaties. We also draw on budget accounts, we draw on annual reports, and of course on more standard data sets like the World Bank and OECD lending data. We have an extract from the DRS, World Bank DRS, that was shared with us, which greatly advanced our understanding of the past decades. The data set, and much of what I will show is very, much of the graphs I will show today are very on an aggregated long-term level, but the data set itself is actually micro level. So we have 230,000 individual grants and loans by 134 governments and 50 international institutions. So it's actually a very detailed data set. Who are the creditors that we focus on? Well, historically, it's basically bilateral creditors for foreign colonial offices, Ministry of Development, export banks, and central banks and treasuries. But with World War I, you saw the emergence of an international system of multilateral and regional creditors, so the League of Nations, the UN, the BIS, the IMF, and a large set of regional development banks and regional safety nets, such as, Arab Monetary Fund, or think of the European schemes. For each of these creditors, we collect loan level information. We collect, of course, characteristics, interest rates, maturity, and if possible, also strings attached. So any, policy conditionality, strings of, collateral, etc., wherever we can. Compile this data for all these different sources, then cross-check across sources and build kind of a consensus data set across sources, looking for, whenever we have conflicting information, for additional sources, so as to have a as reliable overall data set as possible for the sample, for the long sample we have, and set up this data set that I will now show, the main results of. Just before I do so, here are a couple of examples. So these are historical budget accounts. On the left side, this is an example from the from Great Britain, showing you, how much debt was outstanding towards Portugal or Russia or Bavaria, and you can do that for both, the debtor country and the creditor country, cross-check over years, and then also gather additional information whenever possible. For the lending by communist countries, we had a major gap, but fortunately found a source, of CIA reports that were recently released. So the CIA meticulously collected information on lending between the Eastern Bloc countries, between China and Cuba, or Russia to African countries, allied or non-allied, so that we have a very rich picture of actually what on Soviet lending and allowed us to bridge the 50s, 60s, and 70s in that front. So in other words, we do draw on quite a range of sources, as you will see in the paper, and that helped us to get a fuller picture. We coded disaster, as I said, in a very broad way. We draw on first financial crisis, so banking, currency, and sovereign debt crisis, using standard sources. We also draw on wars and military conflict, so this is the Corridors of War project. And we draw on natural catastrophe data. Here we go with standard MDAT source since 1900. The problem there is it stops there. So for the 19th century, we needed to set up our own data set of major earthquakes, storms, floods, volcano eruptions, famines, and epidemics. And we did so again using a broad range of sources on these disasters, and those are detailed again in the paper appendix. So given that this is a very short talk, let me just highlight some of the key takeaways. So what were the research questions we were after? The first question we were after is, how large is this? So how large is this universe of international official lending? And one interesting takeaway for us is that it is larger than we anticipated, particularly when compared to total private international capital flows. In fact, official lending in crisis and disaster episodes often surpasses a total private international lending, and that to us was quite continues to be stunning. We find that rescue lending has a very long history. So these official rescue packages, these official loans go back far earlier than the IMF and the World Bank, which is kind of the focus that much of the literature has today. What we find, however, is that this lending is much more spiky in the 19th century, much less institutionalized. And so we have seen a globalization of assistance in that sense. We had an era of hyperglobalization in the late 19th century, but that was not accompanied by large-scale official flows. Today, in the second era of globalization, if you want, since the 1970s, we see much more official flows along with these private flows. So we have seen kind of in that sense, or one interpretation would be that with similar level of economic integration, official assistance, or maybe the world has become more altruistic in that sense and more interconnected on the government level. But that's of course a hypothesis that is hard to test. The second main takeaway is that we find this interaction of private and official flows. When private flows retrench, official lending often steps in, and that's something that you've seen for the COVID crisis. That is very typical for other episodes as well. In other words, private flows are pro-cyclical, whereas official flows are counter-cyclical. So there's a lot of, we think, a lot of need for research on what are the insurance benefits, what are the risk-sharing implications of these official flows. I think we know much too little about that. Sebastian is working on a paper looking at that, but much more needs to be done. So there's a fascinating interaction between private and official flows throughout these 200 years. And the third takeaway is that trade and financial integration explains a large degree of these rescue flows. So we basically ask, why are some countries willing to lend to others in crisis situations? And we draw on economic theory. We basically bring the Tirol and Gorinchas et al. Model to the data and ask, so what drives these flows on a country by country levels, on a dyadic level? And we find that economic exposure pre-crisis is a good predictor of the size of bailout. So the more integrated two countries are, the more they trade, the more the bankers and exporters are exposed with that other country, the more likely the government is to help the other country out via official loans. In other words, to arrange a bailout. So whether that's a selfish motive or altruism is in the end of the day an interpretation issue, but it's certainly in line with these Tirol and Gorinchas point of view of basically you rescuing your own exporters and your own bankers. So let me just show you a couple of the key graphs that we collected from the data. This is a graph showing you aggregating all the official loans from in our database by year, and then dividing that by center country GDP. So this is US and UK GDP. UK GDP until 1914, and afterwards US GDP. The reason we used US and UK GDP instead of global GDP is that global GDP estimates in the 19th century are very messy, whereas the UK GDP, there's all industry estimating, the size of UK GDP, and those are more reliable numbers. But the overall picture looks very similar if we look at world GDP. The key takeaway from this graph is what I mentioned before, is that official lending, bailouts, and war-related lending is much older than some people might think. It goes back 200 years, and we see two pronounced spikes, especially during World War I and World War II, showing just how disruptive global wars are for the international financial system. Of course, this is to a large degree military aid, but that is, you know, part of our definition of official lending. Just to put the size of these flows in perspective, this is 10% of US GDP transferred in a single year on a global level between governments. So that's in today's value would be 2,000 billion US dollars transferred in a single year over multiple years. And that, compare that to the historic EU recovery fund, which accounts for 750 billion, so less than half to what was transferred in a single year in World War I and World War II. And that's the 750 billion European recovery funds will be spread out over a number of years, right? So these numbers we are seeing today pale in comparison to what we have seen during the world wars. And even the record bailouts in the great financial crisis of 2008 and the Eurozone crisis that followed don't come close to what we have seen in that era. We also see, as I said, this institutionalization of official lending, with multilateral creditors coming in, more importantly from the 1970s on, mainly IMF and World Bank. Historically, it was pretty much only bilateral, so government to government lending. And as I said, it's much more spiky in history and much more institutionalized today. Just to reiterate, bilateral lending is the key was the key way of transferring funds between governments historically. It starts in 1900. IMF and World Bank came in the 60s and 70s, but what is often forgotten is just how important regional you know, these regional financial schemes have become. They are in fact on the rise. We see more of that, and that alone is a fascinating observation. So why are we seeing more of these regional schemes if, in the end of the day, from a pure insurance perspective, it would make much more sense to come up with global schemes? You know, when, you know, in the midst of the Euro crisis, all European countries were in a recession or were close to recession, and then bailing each other out is not the most efficient way to pool. So why are we seeing these regional schemes? What drives the use of IMF versus regional versus bilateral lending, etc.? Those are all questions that, you know, have partly been explored, but I think much more could be done. Now, let's turn to one other aspect of lending that so far I haven't discussed, which is the central bank to central bank lending. This is part of an ongoing effort to code all central bank, intra-central bank credits over the past 200 years, again scaled by US and UK GDP. What you can see is that the size of these loans between central banks, you know, historically they took the form of short-term credits. Today they take the form of swap lines. You know, swap lines have somewhat of a different character. They're partly collateralized, they are overnight, and yet they fit the definition of international official lending that you know, we follow, and based on the OECD and IMF definition. And what you can see is that the scale of these central bank swap lines is quite remarkable. Again, 3% of US GDP transferred in the 1930s crisis, and as well in 2008, and again in 2020 in March, volumes were close to that level again, right? So this dimension of central bank to central bank rescue lending is fascinating, and does not change the overall picture of our in this paper, but shows you that it is an increasingly important element of global official financial transactions. When we add these central bank swaps and credit lines in red here, and then add that to the figure that I've shown before, which is the official loans aggregated per year across these 200 years, you see that two main changes arise. So this is the 1930s, you know, when central banks tried to avoid the collapse of the gold standard, and again in 2008. But a part of that, the overall takeaway is not affected from that picture. The second key takeaway is when private investors retrench, official lending often steps in. To make that point, let me show you again our 200-year graph, but what is new here is this red line, which is from a separate paper with Carmen Reinhardt and Vincent Reinhardt, where we gather a 200-year series of private international capital flows. And we do so in the 19th century by drawing on issuance data in Britain from of foreign countries, private placements. And we combine that with a new data set on net flows from the World War I on. So this is the red line, and what you can see, and that's the key takeaway, is that the red line and the gray shaded area are inversely related. You see that when private capital flows collapse, as during World War I, during what Eichengreen calls the mother of all sudden stops after 1929, in various crises of the 60s and 70s, but also, in the 2008 crisis. In all those episodes, you see a collapse in private flows and a spike in official flows, and the overall correlation is negative and significant. And this is, of course, to some degree comparing apples to oranges, because this is net flows for the past 100 years, and this is gross commitments. So we've delved into individual episodes. I don't have the time to go into them in detail, but both for the interwar and the Great Depression, you see this inverse relationship of red private flows and dark shaded bars official flows. And also during the Eurozone crisis, you saw, a boom in private capital flows to Greece, Ireland, and Portugal, Spain. And when those collapsed, you saw those large-scale official rescue operations. So that seems to be a recurring pattern, these inverse relationships. Now, time is short. I only have 4 more minutes. So let me use those to emphasize, the last stylized facts. Why do countries actually extend rescue loans? What can we see in the data? Can we identify some predictors of these loans on a bilateral level? What we do is to look at, focus on the subsample of disasters, and then look at, who are the recipients of these official loans. And before I delve into the econometric analysis very briefly, let me just show you this fascinating stylized fact. This is the simple probability of receiving official loans in a major natural disaster. The pattern looks very similar for wars and financial crises, but this is natural disasters. Countries experienced a natural disaster before World War I had only a 10% probability of receiving any international assistance, right? Compare that to today, and that's basically 100%. So today, pretty much all major disasters are accompanied at least by some type of official international aid and transfers. And in the paper, we have quite a number of cases illustrating just how much this has changed. I mean, you had major famines in Persia in the late 19th century, for example, with zero flows, millions of people died, no international response. Whereas compare that to Haiti in 2010, the major earthquake, Haiti received almost 100% of its GDP in the aftermath of this earthquake. So that's a completely different scale that was, nowhere to be seen in history, besides a few maybe episodes of war financing. Why do countries extend rescue loans? What might be behind these trends? Well, one predictor is economic exposure. That's at least what Tirol and Gorin just emphasized. So they predict that states will grant credits to other states if the economies, if the banks, if the exporters are closely linked, if there are potentially spillover effects. So in order to shield your own economy from spillovers from the crisis country, you grant credits to the crisis country, so that country avoids a crisis, avoids a major recession, and the donor country is better off as well. So kind of a preventing negative spillover story, but of course that could also be interpreted as just helping those countries you are most economically interacted with, so kind of your friends. To check this relationship, we look at the dependent variables, the amount of rescue loans in a subset of disaster episodes. We're looking only at crisis episodes, so it's a selected sample. We're working on the bigger sample of all years, but this is just the crisis years, and we regress that on pre-crisis economic exposure, political ties, and standard gravity controls. So just to give you a graphical preview, what this graph shows you is that we have bilateral trade data. That's important. This is all dyadic, right? This is bilateral data. This is a standard gravity equation as a state of the art, accounting for any zeros, heteroscedasticity, and all those factors. But the data is dyadic. That's crucial. So every dot here represents a official loan granted between two countries, or flowing between two countries. And the horizontal axis shows you how closely those two countries are linked in terms of bilateral trade shares. So you can see the closer two countries are in terms of trade, their trade relationship, the more likely there will be the larger the official loan. So this is actually the size of these loans, the larger the official loans flowing in crisis situation, and that's trade. And we get a similar picture if we look at banking exposure. So using the BIS data, which is available only from 1984, but we see the more two countries are linked financially, the larger the international official loan transfers between them. This same pattern is reflected also in the regression results. So 1% higher trade exposure is associated with 0.34% more official loans. And that is true not just for the full sample, but also for the various subsamples over the past 200 years of the international financial system. So to conclude, official lending is much larger than previously known, and existed long before the IMF and the World Bank. Official lending rises in terms of disaster, and we see that there has been this institutionalization of official lending that has increased considerably, and we expect, looking ahead, this phenomenon of official lending to increase further, not least because of the rise of China and its very active use of official lending vehicles. Thanks a lot.
Thank you very much, Christoph. That was very enlightening. So it seems we're heading for a better world, right? When private flows stop, the state steps in. We're more likely to help our neighbors and business partners, and in disasters, everybody comes to help, right? Well, sounds like a good picture. But please, I'm happy to hear some comments and questions. I know there was a question from Gear Marcos, so I'm trying to promote you so you can actually ask your question in person. Shall we try that? Yes, there.
Sorry about that. That was actually an accident. So I don't really have a question here. Sorry.
Oh, don't worry about that. Okay. But there is a question from Pallavi Chawan. It's in the Q&A function, Christoph. Can you probably see it and read it yourself?
Yes. So if I see that, basically the Pallavi asks not just to look at the amount of flows, but also the terms, right? So how have terms changed over time, meaning interest rates, collateral, and whether we include grants. So the short answer is this is not yet part of this draft, but it's definitely something we are at. We will show more detailed results on the terms of these loans. The bottom line is, historically, the terms were not very concessional. So interest rates were actually quite high on those loans before World War I and World War II, and became more concessional in the last years. That includes in the last decades. That includes grants and aid flows, which are often zero interest rate, multi-year or multi-decade maturities. So we've seen a shift also, not just in volumes, but also in the degree of concessionality, right? And we will show that in more detail in the new version of the paper.
So let me just quickly try something, because I have promoted Catherine and Maria now. Let's see if they want to ask their questions live, just for the sake of having a conversation. Catherine, can you try to? Hi, Catherine. Hi, Maria.
Great. Thanks very much, Christoph. Great paper. I just wondered, you had kind of raised the example of Haiti, which made me wonder, you're seeing an increasing incidence of lending into disasters, but whether that's a good thing or a bad thing, or whether it's helping with the recovery or not. And just another minor point of information on your central bank swaps data, which was really interesting. Is that end year outstanding swaps, or is it higher frequency? Because certainly for the swaps that I looked at for the 1960s and 70s, you know, they collapse at the end of the year for reporting purposes and stuff. So just a point of information, that one.
Yeah. So on the first one, I don't have a good answer because we haven't looked at that, right? That's a fascinating, I mean, it's something that the literature on the IMF and the World Bank has been after, right, for decades. You know, what is the return on this? What is this? Does conditionality work? Is this, you know, something to be applauded, or is this only just kind of a moral hazard transferring to the private sector? In this paper, we don't have answers to that. What is certain is that indeed there is a secular increase. So one interpretation is that states at least have the perception that it is, you know, more beneficial today than it was in history. But you know, what ultimately explains the big secular increase and what the consequences are for recovery, and whether, you know, you might have also, you know, not just creditor moral hazard, but debtor or country recipient moral hazard, right? In terms of like hoping.
Moral hazard for disasters is probably less than it is for profligate spending, but
that's true. But you can also be, you know, more preparatory, right? I mean, whether you accumulate reserves or prevent, you know, build up disaster relief facilities. So it's a fascinating question. I mean, what lurks behind, of course, this whole agenda is also like a question of there's a couple of theory papers on optimal bailouts, right? Both on the banking and sovereign side. It's very hard to bring these to the data, but maybe the you know 200 years and using institutional variation, we can get somewhat closer to that. But so far we've shied away from this, you know, mega question. On the central bank swaps, I see the point, definitely. We do not, we kind of gathered the intra-year credits as well. As I said, this is work in progress. This is not, you know, the central part of this project. If we were only to count end of year, it would be smaller. Right, so the same goes for swaps, right? So therefore, to some degree, this might be higher than if we just, you know, count swaps once, you know, these three months. Sorry, the short-term loans, which are 3 months, 6 months. But it definitely shows how you know how regularly these credits were given out. The overall picture does not change strongly, right? But of course, but that's definitely work in progress, and we're tracing that. We found quite a few additional loans that, you know, we weren't at all aware of. You know, we knew the Eichengreen and all that, but okay, but I don't want to be deterred. But it's definitely a very fascinating episode.
Okay, let me just to quickly moderate a little bit. So there's a question from Maria. After that, it would be Horst, then Martin, and then there's one in the chat as the last one. I can't read the name. So Maria, please go ahead. What's your question?
Hello, thank you. Hello, Carmen.
Hi.
Nice to see you again. I was just wondering, when I saw the amounts that you're showing, lately there are huge amounts of funds donated to refugees and to immigration crisis. I wonder if these flows are included, or are they mainly grants, and then they are excluded from your statistics? Thank you.
The short answer, yes, they are excluded. So we have, what is missing, I think, is a history of international aid. We don't have a ready-made data set on aid flows, and we didn't want to do that as well. So we shied away from, you know, we therefore stick to this, you know, IMF OECD definition of official lending, which does include grants, loans, but not these kind of aid flows in a narrow sense. Of course, sometimes it can be hard to distinguish, but we try to stick to, you know, basically what the finance ministries themselves, how they define it, and how the World Bank would define it. But I think your question is excellent in the sense, like, one would like to see how aid comes in there and how the volumes compare, right? It's fascinating also to understand how this whole history of aid developed. I think I was a bit disappointed that I could learn so little from the existing literature, but maybe I didn't look closely enough on but I would like to see kind of a 200-year history of this, also from private, but of course that's hard to do.
Thank you.
So Horst, do you want to ask your question? I know you wrote it in the chat already.
Yeah, I can try to repeat it, even though I can't see my own question anymore since it disappears from the chat. I think.
But you do remember it.
Yeah. Remember. Yeah. Well, I was wondering, have you tested on the official side to distinguish between the IMF and the bilateral and MDBs? Because of course their reasoning outside crisis situations maybe is fundamentally different. I mean, the IMF doesn't really want to lend, it only wants to come in as a lender of last resort. And what I recall from presentations from the evaluation office of the IMF saying, okay, if somebody wants our money, we want to make sure we give conditionalities that they want to step away from it as quickly as possible, while of course all the MDBs and the World Bank, and I'm working in one of them, actually have an agenda of wanting countries to take their money. So it's quite a different reasoning behind it. And of course, I also see that we have increased lending now in the post-COVID, or I think almost doubled last year. But of course, I do not perceive that when the crisis finishes, there's an active policy to slow down, to leave the room to the private sector again. It might happen, but not by intention, I would think. So will your picture change if you distinguish between the two reasons of lending of the IMF and the bilaterals, multilaterals?
So, I mean, I certainly agree that indeed, I mean, that's in line with what I said on the institutionalization, right? We see this kind of like, there's countries, even with the IMF, you know, these kind of these serial IMF programs that look more like, you know, 40-year loans than 3-year IMF programs. So even the IMF in Africa, at least, is engaged in kind of serial lending and is not exiting the same. And what that's certainly more true. So for the MDBs and the others. Now, distinguishing between motives is a bit tough. I mean, in the regression analysis that I showed you, that's only bilateral lending. I should have maybe emphasized that clearer. That's only the bilateral side of those loans, and not the multilateral. We are in the process of adding that and comparing, you know, basically a horse race between drivers of bilateral lending and multilateral. Of course, that's not possible in the dyadic setting, or at least not as easy. But maybe a bigger point to your question is, it's not, I mean, it's a fascinating question. I'm not sure we can answer it with this data, but at least, you know, looking at the 200 years, are the motives really so different, right? At the end of the day, I mean, or are the IMF and the MDBs just a veil, and behind that veil are the same motives that have driven that kind of lending for the past 200 years, right? Or at least they're the same motives popping up in various settings and various situations, and then eroding again. So how much of the multilateral IMF lending is really so special compared to the bilateral? That I think is a question we haven't yet answered, and I haven't seen it in literature clearly. And I think, you know, this long run perspective opens up maybe a little bit on that and addressing that point. Because there are these people that say basically the IMF are just political economy agents of certain states. You know, of course, you know, they haven't been particularly successful at showing that in a big picture way, I think. But there are these arguments, right? So short answer is, you know, for the key takeaways here, it doesn't matter so much. You would just drop the red parts, right? And pretty much the entire long-term graph would look similar. The regressions don't have it. But I think what is behind your question is a much bigger, you know, one in the sense like, what can we actually learn by looking at these different lending motives specifically? There's an interesting book by Jon Bunte. He's looked at the motives for lending that, you know, gives some insights on why countries choose which creditors. I found that very interesting. Yeah.
Thank you. Martin Hall, would you like to ask your question? He's not here anymore. Okay, so we can move on. There was a question in the chat from someone whose name I don't read Chinese, so I don't know. So the person is asking if we can assume that, given that, in his opinion, like we're moving from globalization towards regionalization, that this is going to happen as well to lending, that it will be more local, more political. What do you think, Chris?
I mean, that's an interesting question. I would have to leave the safe territory of the paper, I guess, to answer that question, and speculate a little bit. And I think, I mean, just from a theoretical perspective, why are we seeing this move to regional arrangements? I guess one reason are the restrictions, and many of them political, keeping countries from, we've seen it in the Eurozone crisis. Germany didn't want the IMF to play the only role in bailing out Greece. And so that's also true for other regions. And that, I think, comes along if there are these political frictions. In response, you see more regional schemes coming up, because there seems to be a demand for these bailouts that is not sufficiently met by multilateral organizations. So in response, you see this creation of regional schemes, and by definition, these regional schemes, I think, are set up because of political frictions, maybe mistrust, or the lack of enforcement. You're less able to convince Malaysia to maybe repay than your neighbor France or Italy. That these enforcement problems drive regional arrangements, and because of these political frictions, so that would mean that it also becomes more politicized. Which is not to say that the multilateral lending is not politicized to start with, right? And bilateral lending is also highly politicized. These are states lending, right? So this is politics front and center. This is not something we look at in the paper, but there will certainly be a follow-up on the geopolitical motives of this, and maybe then we can get a bit more closer to answering that question, which is excellent.
Okay, thank you. Martin, would you like to ask your question? It's probably the last one for today.
Okay, thank you very much. Interesting set of data you got there, and I think there's more in it than you've actually shown us. I'm a little sorry that you went so fast over the pre-last slide. Would have liked to look at it more closely. What I wonder, it may be a simplistic question, but the economic integration of the world has been much stronger in the years before the First World War than afterwards. And financial integration has also been higher than in the years after the Second World War. So, but from what you've shown us, the probability of getting official loans has risen quite straight. So I'm having a hard time getting this together with trade exposure and financial exposure being the main driver. Maybe you can comment on that.
Yeah. So I think this exercise helps to understand the bilateral, so who lends to whom question. And their exposure seems to play a role both in history and today, but this exercise does not help to explain the secular trend.
Okay.
So the big picture is not answered by this table, but there is not really a theory on the big picture. There's a theory on the bilateral setting, and that's one we can test and look at, and I'm also, we do have less of we do have a higher coefficient here, right? Indicating that exposure might have, mattered more back then, but I wouldn't overinterpret these coefficients at this point, because we're just struggling with so many zeros, and we're revamping the whole exercise. I mean, given that, in history, the probability was so low, you have to be, there's a much higher problem with zeros here than with trade, right? And they already struggle with it. So that's why I would be cautious in overinterpreting this. We do see clearly in the data these descriptive patterns, so that's why I think the pattern is there. But I would like to answer your question by interpreting coefficients, but I don't want to do that in this.
Okay.
Right.
I understand.
I think your question is excellent in the sense that why is there so much more today, and why is there so much more official lending today? Why was there no globalization of official lending when states had so much more power in some sense then, and there was this whole diplomatic and alliance system, you know, think of Bismarck and all that. Why wasn't there more response on the official level? Answering that question, I think, is hard, but one that, you know, we want to get to, and I think maybe the geopolitical dimension is important, but yeah, it's hard to answer. It's one of the puzzles, you know, that, you know, time series.
Currency systems and a lot. I think there are a lot of factors there.
Yeah.
Thank you.
Thanks.
Perfect. Thank you, everybody, for your participation. Thank you, Christoph, for your presentation and for discussing. I think it's safe to conclude that there is a lot more official lending that we would have probably thought, but there is a lot more work to do about how it connects and why it is done in certain circumstances. So I guess whoever works on that can get in touch with you or with me. I'll forward this. The same goes for whoever works on international aid or the history of international aid is very welcome to get in touch as well.